This LOS is identify the key provisions of and differences between income tax accounting under International Financial Reporting Standards, IFRS, and U.S. Generally Accepted Accounting Principles, US GAAP. Okay, for this LOS, I'm just going to take a screenshot. I'm in the ebook right now, and it's Exhibit 5 from the text. There's the deferred income tax issues, IFRS and US GAAP, methodology, similars, and differences. So we're not going to go through this in total detail. I just wanted to point your attention to it, that they've got the issue on the left-hand side, IFRS in the middle column, and then US GAAP. So they'll talk about the general considerations and then the differences or similarities, okay? So let's just see if there's anything here that catches our eye. So we can see here, revaluation of plant, property, and equipment. Well, we know revaluation of plant, property, and equipment is allowed under IFRS, but it's not allowed under US GAAP. So here we can see the deferred tax is recognized in equity, and under US GAAP it's not applicable as revaluations are prohibited. So these are the things that you could be tested on, okay? Foreign non-monetary assets and liabilities when the tax reporting currency is not the functional currency. That comes up more in CFA Level 2, by the way, under accounting for multinationals. So the deferred tax is recognized on the difference between the carrying amount. Okay, there's no deferred tax related to assets and liabilities on the US GAAP side. So again, not going to go through this entire list. I just wanted to bring your attention that it is in the book, that you can scroll through. There's some issues, you can see things are similar to IFRS with regards to business combinations, acquisitions, presentation of deferred tax, reconciliation of actual tax and the expected tax expense. So it's required here, required for public companies only, etc. So that's the table that you need to know with regards to the comparison of IFRS and US GAAP. So on this slide, just did a couple of points from that chart that I just showed you, comparison of IFRS and US GAAP. So there are some deferred tax differences. For example, IFRS revaluation of PP&E intangibles allowed under IFRS, not US GAAP. Another item, undistributed profits from subsidiaries, associates, joint ventures. Deferred tax assets, IFRS recognized if probable recovery, but US GAAP full recognition can be reduced by the valuation allowance. In terms of presentation, US GAAP is current and non-current, but under IFRS it's non-current. So again, a little bit of time to look through the comparison of IFRS and US GAAP with regards to the deferred tax differences. So we'll just finish this LOS with a practice question. A company has recently revalued one of its depreciable properties and estimated that its remaining useful life would be another 20 years. The applicable tax rate for all years is 30%, and the revaluation of the property is not recognized for tax purposes. Details related to this asset are provided in the table below with all pound values in millions. So we can see have the accounting purposes and the tax purposes. The original values and estimates at the start of 2007. So the acquisition cost was £8 million. And the depreciation straight line, accounting purpose 20 years, tax purposes 8 years. Cumulated depreciation at the end of 2009, therefore tax purpose is going to be higher at 3,000 versus the 1,200 for accounting purposes. And then there's re-estimated values and estimates at the start of 2010. So the revaluation balance at the start of 2010, accounting purposes 10,000, and tax purposes it's not applicable. And the new estimated life is 20 years. So the deferred tax liability in millions at the end of 2010 is closest to A, 690, B, 960, or C, 1,650. Okay, this one's a little bit of a tricky one, but not too bad. So at 2010, the start of the year, the balance after revaluation is that for accounting purposes, the asset was revalued at 10,000, and the carrying value for tax purposes was 5,000. Okay. Now we have to calculate the revaluation surplus. At the end of 2009, the carrying value of the asset for accounting purpose was 6,800. So 10,000 minus 6,800 is going to equal 3,200. Okay, so that's our revaluation surplus. So the way that this works, so the depreciation is still straight line over 20 years. So the balance at the beginning, 10,000 divided by 20 years, we have depreciation of 500. Here we've got 5 years remaining, and the depreciation is 1,000. Okay, so we have our net balance at the end of 2010, 9,500 versus the 4,000, but we have to deduct that revaluation surplus of the 3,200, which was our new value minus our carrying value from the previous year. So it's not too difficult. So we get the carrying value for purposes of deferred taxes is 6,300. 6,300 is greater than the 4,000. So all we do is the 6,300 minus the 4,000 times by our tax rate of 30%, and we get the correct answer, which is 690, which equals B. Okay? So note here, only the portion of the difference between the tax base and the carrying amount that is not the result of the revaluation is recognized as giving rise to a deferred tax liability. The portion arising from the revaluation surplus is used to reduce the revaluation surplus in equity. So that's the key. This is a pretty important question. It's not very hard in terms of the calculation, but you just have to know how to go through the steps. That you start with the revaluation surplus, which is not bad. It's the new value minus the old carrying value. And then you get your new value, depreciate it for the year, get your new balance, subtract that valuation surplus, and then you've got the carrying value for purpose of the deferred taxes, subtract it from the tax carrying value and multiply it by the tax rate, and that's how you get your deferred tax liability. Okay, that's the last slide for this LOS. Thank you.